My name's Gina Buckles. I'm one of the advisors at 401k Plan Professionals. And on behalf of my colleagues, Jessica, Jenna, Virginia, Kristen Carlin, and myself, we want to thank you for hopping on this webinar about Secure 2.0. It's something that we're very passionate about. I'm very excited about it. We've been talking about some of the provisions in Secure 2.0 for, in some cases, many, many years. And we're all advisors, and we're all part of an organization called NAPA, which is a group of retirement plan advisors across the country that has an opportunity to meet with our congressmen and women on an annual basis. And it gives us an opportunity to really push the legislation that we feel is meaningful for American workers, to help them save more for retirement, to offer retirement savings to more people, to increase their financial wellness. And that's really, I think, the unique thing about Secure 2.0. It's very robust. There's a number of provisions in it, but I do think it's really meant to drive better results. So again, just excited about a lot of the changes with Secure 2.0. A little bit more about the act. So Secure 2.0 was passed December 29th, 2022. So, about 6 weeks ago. It was attached to a broader spending bill, and it actually builds on the original Secure Act. So that stands for Setting Every Community Up for Retirement Enhancement. We love to use acronyms in this industry. That was originally passed in 2019. So it does build and expand on, some of those initiatives. There were 92 provisions included in the Secure Act. And like I said, I think really the spirit of the act was to really promote more retirement savings, to help Americans financially, and give incentives to businesses, to really offer these benefits. A couple unique things too, I think, about Secure 2.0, a lot of the provisions are optional. So a lot of things we're going to talk about today, I think they're unique. I think they can be impactful. I think they can be very effective, but you don't necessarily have to adopt them as a plan sponsor. There are a few provisions that are mandatory, so I will make sure that I point that out. And they all have a very unique effective date. So that's also something I'll try to be very clear about as we go through the provisions. Good news, I'm not going to go through all 92 provisions. I only picked the top 15. And I picked the ones that I thought were most important to you as plan sponsors or as plan participants. So these are a little bit more specific to the audience today. But again, just know that it's a very robust piece of legislation, and there's a lot more than what we're just going to talk about. So let's go ahead. We'll start with the top 15 provisions. Again, I've got a lot to go through in 30 minutes or less. And I will leave time for questions too. So if you do have questions, I will kind of keep my eye on that chat, and we'll leave obviously more time for open discussion at the end. But effective in 2023, I'm going to try to go in chronological order, is the required minimum distribution age has increased. So effective this year, the age is now 73. The age was 70 and a half for many, many years. Secure Act, the original Secure Act in 2019 raised it to age 72. And now, again, this year, we've raised that to age 73. In kind of a unique move, Congress actually added another age increase in 2033. So it'll be age 75 in 2033. Obviously, we're happy about this. It's acknowledging that Americans are living longer. They're living longer in retirement, and they should be able to tax defer their money longer as well. Also, with regard to RMDs, there was another good piece of news with regard to the penalties. So for missed RMDs, the penalty had been 50%, a 50% IRS tax penalty of the RMD amount. That is really, really stiff, especially when I think most people who miss their RMD, it's inadvertent. There's a variety of reasons, why people miss those RMDs, but the penalty was really, really stiff. So now it's going to be reduced from a 50% tax penalty to a 25% tax penalty. And if it's corrected in a timely manner, the IRS says if it's corrected within this correction window, it might even be reduced to only a 10% tax penalty. So still very important. We never want anyone to miss their RMD, but again, at least the cost and the penalty amount has been reduced. Also in 2023, the legislation offers employers to give financial incentives to their employees to participate in their 401k plan. So this is kind of unique, and we probably need a little bit of guidance on this provision as well. They did cite in the legislation that you could use low value gift cards, but they didn't give us an amount. I don't know, it's a little arbitrary right now, whatever you deem as low value, but we are looking for a little bit of guidance on that. So that's nice. I know a lot of employers have asked to do something like that. So in 2023, also, they are allowing employer contributions to be designated as Roth contributions. This is something I know plan participants have asked me about. Obviously, there's a lot of Americans who want to build up as much tax-free income in retirement as they possibly can, and to designate your employer match or your employer profit sharing contribution as Roth would help. And we're big proponents of Roth contributions, especially for younger investors, people who don't need that tax benefit today. Roth is ideal. A couple of things to consider, though. The provision does say that these employer contributions that are designated as Roth, they must be 100% immediately vested. And what we're not real clear on is, does that mean the employer has to have 100% immediate vesting schedule? Or if you do have a vesting schedule, can only those people who are 100% vested designate their employer contributions as Roth? So we're a little fuzzy on that, and we have asked for more guidance. I think some additional challenges with this is payroll providers and record keepers need to be prepared to do it. So there needs to be another money source. So now you need a Roth match source. We need to be able to record keep that separately. Your payroll provider needs to be able to, tax that income appropriately, because it would be income that's included in your taxable income this year. So I think there's, I think in the haste of getting this done, and obviously Congress likes Roth contributions because it raises more tax revenue for Congress. So I think they wanted to get it in the legislation as soon as possible. But I think, I would probably pause on this and maybe wait for a little bit more guidance. And again, if you're interested in doing this, reach out to us as your advisor. We'll be an advocate for you, but I do think we need to make sure that systems, record keeping systems and payroll systems are set up appropriately to do this. But it is good news. I'm really pleased about this. I do think it gives people an opportunity to increase, their tax-free income in retirement by doing more Roth. But again, more guidance probably to come on that provision. A couple other provisions. These are effective in 2024. So one thing that will be mandatory in 2024 is it will require that all catch-up contributions be made on a Roth basis for any employees who have compensation over $145,000 in the previous year with that employer. So this is FICA income. So again, this will be for all catch-up contributions. Again, probably a little bit of a challenge for plan sponsors and record keepers. You're going to have to identify who those folks are. But again, just keep in mind that any catch-up contributions are going to have to be made on a Roth basis for those higher income earners. Also, required minimum distributions from 401ks will now exclude Roth contributions. So let me explain that a little bit more. So, you have Roth IRAs. You don't have to take a required minimum distribution from a Roth IRA because you've already paid tax on it. In a 401k plan, it didn't work quite that advantageously. currently, if you have a 401k and it has Roth and pre-tax contributions, and I have to take a required minimum distribution, that required minimum distribution amount is calculated using my account balance on January 1st, whether it's pre-tax or Roth. Now in 2024, we're going to calculate that required minimum distribution amount. We're going to take out that Roth portion and it'll be calculated just on the pre-tax portion of your 401k account. So essentially making it consistent with Roth IRAs. So ultimately, it will be a lower RMD amount that you'll have to take if you have Roth contributions in it. So I hope that makes sense. Again, if you have any questions, but I think that makes sense. And again, it just makes it a little bit more consistent with the other Roth IRA rules. Also effective in 2024, addressing the need for emergency savings. So this is something that we have, I think as financial advisors, specifically talking to 401k participants, this is very apparent to us that a lot of Americans they're not prepared for unexpected expenses. And, when we talk about financial wellness, one of the first things we always tell people, even before they contribute to their 401k, is to have an emergency savings account. And, there's a lot of statistics out there that Americans just don't. I think 4 in every 10 Americans would not have the resources to cover a $400 unexpected expense. So we need to address that. And, there's a couple ways you can do that as a plan sponsor. And again, keep in mind, these are optional provisions. You don't necessarily have to adopt them. But one provision allows plan sponsors to give up to $1,000 for certain emergency expenses, and they've defined certain emergency expenses as just unforeseen expenses, so it's a little bit broad. The distributions would not be subject to a 10% early withdrawal penalty. And, to avoid abuses, they have put some restrictions on it. They'll only allow one distribution per 3 years, unless it's repaid to the plan or replenished. So I'll give you an example. If you allow this provision in your 401k and somebody takes out $800 to cover an unexpected car expense, they cannot take another one out for 3 years unless they contribute $800 back to their 401k account, or unless they repay that $800 to their 401k account. So again, I think it's set up to address the occasional unexpected expense without, causing abuses and, excessive withdrawals from 401k accounts. But the nice thing is that, it's not going to be subject to an early withdrawal penalty. Now, another provision that's a little bit more expansive, a little bit more robust, is what we call a pension-linked emergency savings account. We like to use acronyms in our industry. We call this a PLUSA. So this gives employers the option to automatically opt employees into an emergency savings account that is kind of a sidecar or attached to their 401k account. They can choose to automatically enroll their staff up to 3%, up to a maximum of $2,500 into that emergency savings account. Again, this is kind of linked to their 401k. It has to be made on a Roth basis, and it has to be invested in a conservative investment option. So think stable value, money market. That's generally what we would recommend you put your emergency savings in anyway. The unique thing about this is it won't be subject to taxes, penalties. Again, it's Roth, it's on a Roth basis, but so it won't be, it's already taxed, but there won't be any taxes, penalties, and there can't be any fees on those distributions, at least up to the first 4 withdrawals from that PLUSA account. So that's kind of a unique option, and I can see this working, especially for employers that do have a demographic that is maybe lower income workers. They tend to have, they don't have an emergency savings account. They tend to reach to that 401k very often. So I think this is a unique provision, but again, both number 6 and number 7 trying to address, that lack of emergency savings for most American workers. So again, optional, but I think good things to consider. Also in 2024 is addressing the student loan issue. So this is one we've been talking about for a number of years. And, just understanding that a lot of Americans that have student loan debt are not in a position to save for their retirement. And that really puts them at a disadvantage when it comes to saving for retirement. And we obviously know that student loan debts are becoming more massive. I think the recent statistic is I think the average college graduate has over $30,000 in student loan debt. So, again, in an attempt to address that and to also help them create some type of a retirement savings, as an employer, you can match an employee's student loan payments. So when we put this in, when we put this in practice, I think there's a couple of unique challenges we have to overcome. But one thing that we did, I think one concern with this provision is who is going to deem that as a qualified student loan? Is it going to be you as the plan sponsor? Is it going to be the record keeper? And with this final provision, they said that it can be an employee's self-certification. They need to certify that it is a student loan, and they do need to certify that on an annual basis. So I think that takes a little bit of the burden away from employers. So you're kind of, putting that burden on the employee to do the own certification that they do have student loan debt. The other unique thing about the provision is it didn't specifically say that it has to be your student loan. So we're waiting for a little bit of guidance on this, but the way it reads right now, it could be your spouse's student loan. It could be your dependent's or your child's student loan. So that's kind of unique, and we'll probably get some additional guidance on that, but I don't think it necessarily has to be your student loan. The other thing that employers need to know is you do need to match it at the same rate as you do normal elective deferrals. So for instance, if you have a match of 100% up to 4%, that's how much you can deposit as a match into that employee who has a certified student loan. That's how much you can put into their account. You'll probably have to do it on an annualized basis. I don't think you can do this on a payroll basis. I think you need to wait until the end of the year, figure out how much of the match they get based on their annualized salary. And that's how much you can put into their account. It's how much you can match. So I think it's probably going to have to be on an annualized basis. Again, we'll get a little bit more guidance on this, but it is out there. I think it's an interesting and creative way to help your staff who's struggling with student loans to open up that 401k account. Again, the idea behind it is maybe when they get hopefully when they get the student loan paid off, they can direct those student loan payments into their 401k as an elective deferral. They already have a 401k open, they have some money in it. And we also know that this shouldn't cause any discrimination problems. So that's helpful as well. So we did in the final legislation, it's not going to be, those matching contributions are not going to be subject to discrimination testing. And you don't have to include those loan payments in testing as well. So that's very helpful. Again, very creative, waiting for a little bit more guidance on that one as well. Also, involuntary distributions, they are raising the limit in 2024. You can raise this from a limit of $5,000 to $7,000. We're big advocates of this. We want to help you as an employer get those small account balances out of your 401k. If they're in your 401k, you are a fiduciary, you are responsible for them. And it is, it is an advantage to get those small balances out of your account as quickly as possible. We're also very cognizant of this for our clients that have approaching 100 or more employees, because you're going to be subject to an audit if you go over 120. And so if you have several small account balances, that adds to your participant account and may push you into a large plan filer, and you may be required to do an audit. So that's one of the other reasons we like our plan sponsors to stay on top of getting those small account balances out of their plan. Keep in mind too, the way these distributions work is not changing. So by that, I mean, if the small terminated account balance is under $1,000, that employee gets a check, less taxes. If their account balance is between $1,000 and $5,000, or if you adopt the new limit, $1,000 and $7,000, their account balance gets rolled to an IRA. So that hasn't changed. So the way it works hasn't really changed, just the limit is a little bit higher. We think this will probably require a plan amendment. So this is actually written in your document. So I do think this one will require a plan amendment if you want to adopt that higher limit. So again, not effective until 2024, but I think that's a good thing to keep those small balances out of your plan. A couple of the things that are effective in 2024, I don't want to spend a lot of time on new plans because I know most of you on this call, you are a plan sponsor, you're a plan participant, you're already involved in an established 401k. But I do think this is kind of unique, and I did want to mention it. Effective in 2024, companies can adopt what we call a starter K. It feels to me very much like a simple 401k. With one big exception, and that is that it has an automatic enrollment feature. So if you adopt this starter K for your staff, you have to automatically enroll them at a minimum of 3%. It can't be more than 15%. It is a very simple 401k that is only employee contributions. There's no requirement for an employer to match. The limits are lower though. They're not as high as a 401k. The contribution limits would match IRA limits. So it's not as generous as the typical 401k. But again, there's no employer contributions that are required, and there's no discrimination or top heavy roles. So again, it's very simple. Works a lot like the simple 401k. It just has that automatic enrollment feature. So I think this is a great provision for gas stations, grocery stores, restaurants, where they have a lot of lower income transient workers. Again, the whole idea behind Secure 2.0 is to expand coverage. So I think it's a unique idea. Number 11, I'm going to deviate from 401ks just for a moment and talk about 529 plans. You can now roll over any excess in a 529 plan to your child beneficiary's Roth IRA. So this was kind of unique. I think this one was a little bit of a challenge to get past, but I like it because, obviously the 529 plan, it was, the whole idea was to help people save for their children's college education, which again, we know that's going to be very expensive. But I think one of the concerns for a lot of parents is, what if my child doesn't go to college? What if they get scholarships? What if they don't use this 529 account? So now this gives you an opportunity to divert some of that, if you have any excess in that 529, to your child's retirement. So essentially building up, a Roth retirement account for them. There are a number of restrictions on this. You can only roll up to $35,000 maximum, and you can only roll up to the Roth IRA annual limit. So for example, the IRA limit this year is $6,500. So if my son had a Roth or had a 529 account, he didn't use it all, I could move $6,500 into a Roth IRA for him. That 529 account, it has to be at least 15 years old. And again, that was a maximum over time of only $35,000. But again, kind of a unique way of addressing that concern by a lot of parents. And again, maybe helping your kids get a little bit of a leg up on their retirement savings. All right, so effective in 2025 and later. This one's mandatory, but again, it really is only mandatory for new 401k plans. The legislation will mandate automatic enrollment and auto escalation. So that means any plans that are effective after the date of enactment, so after December 29th, 2022, someone comes to me and says, we want to start a 401k. By 2025, that 401k plan has to have an automatic enrollment feature of at least 10%, up to a maximum of 10, with a 1% annual increase up to 10%. And again, it's kind of unique. The dates are a little bit unique because if you started a 401k plan in 2023, as advisor, I would probably just tell you to put that automatic enrollment and automatic escalation feature in your plan because it's going to be mandated by 2025. And I just think it's a nod to all of our clients, all of our plan sponsors that do use automatic enrollment and auto escalation. It's effective, it works, and that's why it's going to be mandated going forward. So if you have those features in your 401k, obviously it's looked upon very favorably, and it is very effective. So that is, again, just something that will be mandated for new 401k plans. Also, something that's going to be mandated in 2025 is these long-term part-time employees. So this was actually addressed in the original Secure Act. So some of our clients, they will exclude part-time employees. However, that definition is getting squeezed a little bit, because now if you have a part-time employee who works over 500 hours in 2 consecutive years, they must be allowed to contribute to the 401k. You don't have to, there's no employee, you don't necessarily have to match them, but they do have to be allowed to contribute to the 401k. They're not included in discrimination testing, so it won't mess up discrimination testing. And again, this is just kind of expanding on what happened with the original Secure Act. They had said it had to be 3 consecutive years where an employee worked 500 or more hours. Now it's 2 consecutive years. So you can't exclude those folks anymore. And again, that's not effective until 2025, but that is mandated, and puts a little bit of a challenge, I think, on some of our plan sponsors who do have a number of long-term part-time employees. You're really going to have to track those hours. So, and make sure you don't inadvertently exclude them. But again, that's the whole purpose of Secure 2.0. It's to expand coverage to more people. So also effective in 2025, there's going to be higher catch-up limits. This is very specific to a very specific age demographic, targeted to those employees 60, 61, 62, and 63. So obviously, most employees, some of their final working years, they're going to have an opportunity to contribute a higher catch-up limit. And that catch-up limit will be the greater of $10,000 or 150% of the standard catch-up limit. So let me give you an example. The catch-up limit this year in 2023 is $7,500. 150% of that is $11,250. So that would be the higher catch-up limit if I'm 60 to 63 years old. And also remember what I told you earlier, effective in 2024, all catch-up contributions will have to be made on a Roth basis for any employees who made over $145,000 in the previous year with that employer. So again, you still have that Roth requirement for higher income earners, but again, it's a higher contribution limit, so we'll take it, right? We'll take it. And lastly, provision number 15 is, I think, some really good news that we've been waiting to hear. There will be a retirement savings lost and found account. This will be a national database for all Americans to go to. Again, it'll be an electronic mechanism. It'll be maintained by the Department of Labor. We get this question all the time. I worked for someone 10 years ago. I think I had a 401k account. I think I had a profit sharing account. I have no idea where it is. Don't know if that employer even exists. This will be an easy mechanism for people to track down their old 401k accounts. So again, really, really good news there. I think we can all applaud that one for any plan sponsors who have tried to find lost participants. Actually, I'm going to, before I flash up those contribution limits, just a couple other things too I want to mention about Secure 2.0. There's no amendment. You don't have to amend your plan for most of these provisions until December 31st, 2025. So for many of these provisions, you can adopt them and effectuate them, upon their effective date, in good faith. I would recommend, if you want to adopt, especially some of these optional provisions, that you do a board resolution, or at the very least, you keep it in your committee minutes. But the formal plan amendment is not going to be required until the last day of the 2025 plan year. So you do have time for any formal amendments. As your plan advisor too, we're here. So these are going to be provisions that we're going to talk about a lot in committee meetings. So if some of these provisions, especially some of these optional plan design provisions, if they intrigue you, if you think they would be very appropriate for your demographic, we'll talk about them. And again, many of these provisions, they still merit some additional guidance. When we really look under the hood and we look into the guts of how this is going to work, a lot of questions are popping up. So we are going to get additional guidance down the road. But, if you're interested in these, reach out to us. We'll be your advocate. We'll help you. We'll help you with the implementation and the communication of these provisions too. So just wanted to mention that. I also wanted to flash up the contribution limits, because I think sometimes we take for granted that, everyone knows the contribution limits. Obviously, there were a number of increases, a couple notable contribution limit increases to 401k contributions. Those were raised by $2,000. So you can contribute $22,500 in 2023. If you're 50 or older, there's a $7,500 catch-up limit. I mentioned that earlier. So if you're 50 or older, you can now contribute either pre-tax, Roth, or a combination of both, $30,000 to your 401k. That's significantly more than what you can do to a traditional or Roth IRA. Those limits are still $6,500 or $7,500 if you're over 50. There's some additional limits there as well. Annual compensation limits for 401k contributions, that's up to $330,000. HSA limits increased as well. So, just tuck that in the back of your mind. We always are cognizant of these limits when we're talking to you and your plan participants, but just some additional information that's good to know. A little bit about 401k plan professionals. Hopefully you know and understand our team. We're here always as a resource to you. You can go out to our website at 401k plan professionals. This will be recorded. It will be sent to you if you registered for the webinar today, but you can find this webinar and all of our past webinars on our website or on our YouTube channel. And again, we have some great webinars coming up that we're really excited for. On March 9th, I'm hosting one with one of my mutual fund colleagues at Putnam Investments on engaging the millennial participant. So some interesting data in that. On April 27th, that is our annual summit. So that'll be in person. That'll be at Golden Valley Country Club. You'll hear more about that as well. But we are flying in some fantastic speakers. From JP Morgan, Fidelity. We've got some great topics to cover. So that's just a half-day event. We host, again, a number of speakers, a number of topics, great breakfast and great lunch too. Also in May, we have a presentation on Voice of the American Worker. Again, just some feedback on, just American Worker and how you as a plan sponsor or an HR director can help those folks. And again, we have our next quarterly fiduciary training. Jenna does host those. That'll be on May 18th. So a lot of good stuff coming up. I'm going to pause for a moment and see if anyone has any questions. I know I threw a lot of provisions at you. At least I didn't do 92, right? I only did 15. But I will hang out here. If anyone has any questions, you're welcome to unmute yourself or just put a question in the chat. So I will hang out here and look for any questions in that chat or the Q&A. Otherwise, thank you for hopping on. I appreciate your time. And again, really exciting stuff. So thanks for joining us today.